Hey everybody, welcome to InvestWise Collective's presentation of Ivy Green, our newest acquisition. It's a 100-unit property in Richmond, Indiana. There it is. I'm sharing my screen here. Hopefully you guys can see that. We hosted a live webinar earlier today, and to my dismay, we had an issue with recording the presentation. It was in conjunction with our partners on this deal, J&G Companies. Kevin Burns, Dan Gable, and Nick McCracken were on that call. I apologize. This is going to be a recording that doesn't show their faces. They won't be a part of this presentation. But I will try to do my best to explain their firm, their pedigree, how our partnership came together, etc. And I'm happy to discuss offline. You can always reach me, Paul Shannon at InvestWiseCollective.com. Again, Paul Shannon at InvestWiseCollective.com if you want to set up a call to discuss further after using this presentation as a supplement. Um, so a little snafu, but running this presentation again with just me highlighting the asset, the partnership, and why we like this deal. So I'll jump right into it. A quick disclaimer, this is a 506c offering for accredited investors only. This is not a solicitation to purchase securities. We can only do that through a subscription document, which we intend to furnish in the next 7 to 10 days. I will say this asset and this capital raise for the asset is filling up very quickly. We are, well on our way to reaching our capacity. We're going to be the largest investor in this deal and own 33% of it via a joint venture structure. I'll be guaranteeing the loan and be signing on the debt. But we're getting close to that number. If we do oversubscribe, we will, handle the subscription process in an orderly fashion and allow soft commits to subscribe after we get the subscription booklet. Maybe 7 days or so, we'll give a timeline for first come, first serve. But there's always attrition. There's always soft commits that decide that they have other places to go with their capital or have needs in their personal lives or whatever. So if we do end up in a scenario where that occurs, we'll do it fairly orderly. And just because you're on the wait list doesn't mean you won't be able to get into the offering. So just wanted to say that up front. This is InvestWise Collective. A lot of you guys know who we are, have invested with us before, or have spoken with you and have been kind of watching us for the last couple of years. But for those of you that haven't heard of us or we're new to you, this is our management team. Pat Wills is a CIO and handles a lot of our back office technology and has a good track record in passive investing as well. David Hare is our CFO. David handles a lot of our accounting, bookkeeping, paying distributions, has a really strong financial background, is an investor in real estate and manages his own properties himself as a broker, works for a fund administrator. He's got a lot of synergies that help us incredibly well. And then Ryan Stieg is a business owner, a limited partner, a real estate owner, and has been around the space for quite a long time as well. I'm Paul Shannon. I'm the CEO. I've been in full-time in real estate since 2019 and have acquired and or operated through joint ventures, syndications, et cetera, over 350 residential units. That's either single family or multifamily properties. I've got experience in underwriting, acquisitions, raising capital, property management, done some project management, and I'm also a realtor in Indiana. And I'm also a passive investor. I'm a limited partner in asset classes outside of multifamily, some private equity businesses, have experience investing up and down the capital stack. So I really appreciate being a limited partner as well and having the ability to kind of turn over the reins to a group that has, synergies and some operational efficiencies that I can kind of gain from as a passive investor and exploit, basically passively to generate good returns without having to do as much in the day-to-day operations. As it relates to this deal, we are general partners. InvestWise Collective sometimes will take a limited partner position. In this case, we're going to be joint venture partners and GPs. And this is really right down the fairway as far as our core competencies being multifamily focused and this asset being local to us in Indiana market we're familiar with. So let's go through it. So this is Ivy Green. This is a 100-unit property in Richmond, Indiana, which is on the eastern side of the state. The unit mix is made up of 36 two-bedroom, two-bath units and, 36 three-bedroom, two-bath units and 64 two-bed, two-bath units. So With that, you'll notice there's no single family, or I should say one units or studio apartments. Um, that oftentimes have a lot more turns. These larger units with more bedrooms are really appealing more to the families in the community. So we've noticed that the turns on these types of unit mixes tend to be a little bit lower, which keeps costs down, which we always like. Resident retention, especially in the market that we're operating in today, and I mean the financial market, the economy as a whole. Retention is really, really important and reducing vacancy, et cetera. So we like that about this community. It's 99% occupied today. Oftentimes, hearing from existing management staff who we intend to retain, which I'll touch on a little bit further here in a moment, they have a wait list. Reed Hospital is the largest employer in the market, and this is the preferred community for Reed if they have traveling nurses or people that are moving to the area to work at Reed and need a temporary place to stay. This is a community that Reed falls back on. So that's a really good sign when the biggest employer in town looks at your community as a place to house their employees. And it keeps our vacancy at this property down extremely low. There's not a lot of supply coming to market. I should say zero supply. There hasn't been anything built in 10 years in Richmond. So this property is really well positioned, really well maintained to have solid occupancy moving forward and be a really stable community and a really stable investment. It's a $7.5 million acquisition price, which is 75,000 a unit. It's a really strong basis. To get anything today for under, I'd say 180,000 a unit that's new, if you're talking about replacement cost, to build it would require that kind of capital influx. So we're roughly, half, even less than half, as far as the cost to build something like this today from a cost standpoint. We're going to source 5.7 million in debt through Fannie Mae agency loan, which will be fixed rate. We'll talk about that in a little bit. But we need to raise 3 million. InvestWise is going to bring a million to the deal and be the largest investor in the deal. And as far as alignment is concerned, Michael James, who's the original founder and CEO of J&G, is going to be bringing a 1031 exchange to the property, and it'll be roughly 20% of the total capital that's needed to do the deal. So as far as alignment is concerned, you want to see skin in the game. The management team, our partners, as well as us, are bringing significant capital. We at InvestWise Collective will bring at least a 10% co-invest of our minimum or our commitment, the $1 million. So strong alignment. I do want to touch on J&G since they're not on the call and talk a little bit about who they are. They manage roughly 4,000 units in the state of Indiana. About 2,200 of those units are theirs in their portfolio that they own, operate, and manage. And the other 1,800 or so, they do third-party management for other operators in the state. So they've got a track record of roughly 25 years. Michael James started investing in California, and when he felt as though the investing climate wasn't as favorable in that West Coast market, he moved out to Indiana and started investing here. And since then, this has grown into what has become one of the largest property owners in the state. They're a fantastic property manager as well. They're up for Property Manager of the Year from the Indiana Multifamily Association group. And I think, from a partnership standpoint, we see obviously some real upside in working with them because of their scale, their knowledge of the market, and because they allow us to become vertically integrated. I think having in-house property management is really key to being able to be a successful operator. And I think they see us, they've always done like deals where they've worked with, a core group of investors, and they've grown their investor base a little bit, but they've only ever done 506Bs, and we've done 506Cs. So we've advertised, we've got our own investors, obviously, including yourselves. And, there's some synergies there from a capital standpoint, but they also have noticed us competing on some properties with them and working to source assets ourselves. And we've made offers on some of the deals that they've been selling. And some of the things we're doing at the property level, I think that they feel are creative. We put LED lights in at a property at one point to light, the parking lot, street lamps, etc. And we kind of broke it down over a LinkedIn post of all places to show kind of the cost savings and the analysis and how we looked at it. And they caught wind of that and thought that was really cool. So I think from an asset management standpoint, we bring different perspectives and we can help each other kind of be better as a combined group and a combined partnership than just on our own. So we hope to do a lot more deals with J&G moving forward. But just wanted to give a little bit of color and context behind them and who they are in our relationship. And I've worked with Kevin for a couple of years, and he's become a friend. He was a broker on a deal that I sold earlier in the year, and we've always had a good working relationship. I've looked to partner on this asset. We finally have come together on it. So now, why do we like this deal? Really strong day one cash flow. That's for one. Conservative underwriting metrics have us putting this at about a 7.8% cash flow, distributable cash flow in year one. We think we'll average about 9.1% over the whole period of 7 years. To find a deal that cash flows that well in this market has been very, very difficult. And it's conservative in the sense that, we're not shooting for the moon. If you're a baseball fan, hopefully you watched the World Series this weekend. It was a fantastic series. This is a single or a double. It's a 15% projected IRR. We're not shooting for the moon. There's not some heavy value add. There's not some massive upside. It's just that we're buying it at an attractive basis, and we're going to operate it really, really well, and it's going to cash flow significantly well. So that is the play on this one. At 75,000 a unit, it's roughly a going in cap rate of 7.74. So, I haven't heard of a lot of deals where the cap rate has been that high going in. We're not going to be able to drive that operating cap rate up much higher. We're not doing a lot of interior renovations. There's some CapEx set aside, which I'll touch on in a bit, to update some of the exterior components, which aren't driving revenue. But if we're getting it at that basis and that cap rate, we can just operate the property efficiently, keep the occupancy high, keep resident retention high, and ultimately come out with a really positive outcome for our investors and ourselves. We've got a favorable debt structure that's conservative. It's a 7-year Fannie Mae product. It's got 4 years of interest only. So for 48 months, we'll be paying just interest, which will help with the cash flow, and we'll start to amortize that after year 4. It's about a 5.6% interest rate. We're going to be locking that later this week or early in the next week, but it should come in around that number of about 5.6. And there is yield maintenance. So from a liquidity standpoint, we don't anticipate this being a quick flip. Anything could happen. We'd have to get a really, really strong offer from a buyer off market to be in a position to sell this that much sooner to cover the yield maintenance prepayment penalties. So I would just anticipate this being somewhere between a 5 and 7 year hold. A lot of downside protection with that much cash flow as a buffer. I'll show you the debt service coverage ratio here in a second, but the break-even occupancy on the asset is 73%. That means that essentially occupancy could drop to 73% from 99 where it is today, and we could still meet the obligations to the lender and cover the debt service. And that doesn't include any reserves that we have set aside. It's just in a really downside scenario, that's what we could cover. And then we'd also have reserves on top of that. We could run the property for another probably year at that rate and still be okay. So that's a very unlikely situation. When break-even occupancy is at this level, it indicates that you've got a really strong cash flowing conservative deal. When you see break-even occupancy at 85% or 90%, that's a scenario where if additional supply comes online, that could be a really tough situation for that property if they start to lose residents to competition. So we feel good about that metric and the downside protection or the margin of safety that offers us. Rent growth durability just refers really to the fact that there's no new product coming. This has been a market where there hasn't been anything delivered in 10 years. So we feel that, with 99% occupancy being the preferred community of one of the largest employers, having a sort of an image in the market of being a place where families live, where it's quiet. There's a preserve that backs up to the property. There's a big nature area, a lot of green space, some amenities on site. This is a place that's going to have demand from residents, that's going to usually stay occupied and not have a lot of turnover, and just run really efficiently and smoothly. It's a more modern asset, so 1990s build. I'll show you some additional pictures, but it's really durable as far as the exterior is concerned, all brick exterior. It's in good shape. There's not a whole heck of a lot to do, and there's nothing that's going to be hiding behind the walls, so to speak. It's not one of the older assets where you find aluminum wiring or cast iron plumbing, et cetera, et cetera. It's all today's building standards, so we don't anticipate having any major issues. I will be out at the property on November 5th to walk every unit and do a property inspection. alongside J&G, our partners, and we'll find out when we find out, but I don't think we're going to see anything that's going to scare us away from this one. Unless there's something major that we uncover. This seems to be an asset that's very well maintained with really, really good property records as well. And that speaks to the operational synergies. The existing staff that is on site at this property is going to be retained and hired as employees to run the asset moving forward. They've been there for a really long time to maintain this community and its sort of family appeal. They were telling us some stories as we walked it a few weeks ago about how, the leasing office person said that she would show up occasionally on a doorstep the next morning after a resident maybe at a party or something and got the police called on them. This is, one-off type situations, but she'd show up with a bag and say, "Hey, I'll help you pack, but you got to go." So they really want to make this, a place that stays quiet and stays a solid community and stays occupied and doesn't have people complaining about noise or, young people coming in and partying or anything like that. So we like that. And then on-site maintenance too. They're very efficient. They've kept great records. They know down to the unit when the HVAC has been last replaced, when it's been serviced. They know when the water heater's been replaced. So we got access to that, and we know exactly, what the CapEx is and how much of the existing mechanicals, for example, need to be replaced over the coming 5 years, and feel really good about just the organization and how it's been run. And they turn these properties when they do come open, or they turn these units very, very quickly, where, within 5 days, it's rent ready again. And, if there's a wait list, there's very little downtime as far as units sitting vacant. So we want to get them occupied again, and we want to get that income coming back in. So again, here's just a little bit of the investment highlights. 100 units, 7.5 million purchase, 75K a unit. 5.76 is the loan amount. We're raising $3 million equity. It's a 7-year hold. 15 and change IRR is the anticipated target net returns to the investors. 9.1 average cash on cash, and a 2.37 equity multiple over that 7-year hold period. This slide really just shows this is more of a cash flow opportunity than it is a value add. There's not, some huge upside. 15 IRR over 7 years is pretty good, but it's, it's not a development deal. It's not one where you're going to get 20% IRR. It's one that has got some great tax advantages. We are going to do cost segregation with bonus depreciation now that it's back. And, this bottom of the slide here shows the average cash on cash kind of broken out by year. So we'll see cash flow increase up until about year 4, where it's at 10% on your investment annualized. And then post year 4, we start amortizing the loan. So naturally it's going to drop a little bit. But again, we feel that the cash flow is very durable at 75K a unit or $91 per square foot. It would cost a whole heck of a lot more to actually go out and build a property like this today and make the numbers work. It's very difficult for developers to do that, particularly where the rents are in this market. So we feel like there's probably going to be a difficult sort of barrier to entry for new assets to be built, planned, and get out of the ground. Just to break down a little bit of the CapEx. So about 485,000 is set aside for CapEx reserves from the get-go. We plan to spend that on updating some of the windows, about 50% of the windows, about 60% of the patios. The second floors have wood balconies, about 50% of the roofs. We're going to resurface and restripe the parking lot and make some slight updates to the clubhouse. But you notice it's pretty much all exterior renovations. The interiors are in really good shape right now. There's about 5 units in the community that have been upgraded to, let's call it like a premium level, where they've done new cabinets, hardware, new appliances, LVP flooring, new vanities in the bathrooms, and they're really not commanding that much more income. You're getting about a $50 rent premium for those units, but you have to spend about 8 to 10 grand to get that. And if you do the math on that, it really isn't favorable from a return on investment standpoint. So we will continue to turn units as we need to as they become open. And, if flooring's in rough shape, we'll probably replace it all with LVP flooring. But it's not going to be a heavy lift where we go in and really do a lot of updating of the units. There's demand in the condition they're in. It's an operations play above all else. And what's kind of nice too is that as part of the contract, we're acquiring quote unquote personal property along with real property. A lot of the materials that are needed to do the windows and the patios have already been sourced and are on site. So We have some of that material already, baked into the contract, and it's outside of this CapEx reserve amount that you see here of 485,000. So we'll be able to, save some money on the materials. The labor's still there, obviously, but it should be a little bit more cost efficient to handle some of these CapEx upgrades, which only helps us with our return projections. And then, as mentioned, the mechanicals, just the construction in general, the way it's put together. There's not a lot hiding here. It's a newer asset, newer, construction standards have been implemented here, 1990s or newer. You'll see beautiful looking buildings, nice green space, a lot of ample room. Brand new pool. This pool was just put in at the beginning of May. There was an existing pool that had some damage to it from some frozen water lines, and it had been kind of pushed up out of the ground. So they dropped a new fiberglass pool in and poured this new concrete. It looks amazing. But just open, nice amenity there. You'll see playground there in the background. There's a grilling and picnic area. There's a pet park, dog park. There's a basketball court. What else? There's a ton of green space too. I mean, a couple of these buildings back up to a preserve where residents have talked about seeing a buck that comes out, a deer. And it's just really quiet. It's a really nice setting. This back, you can see kind of in this window here in the upper right part of the screen, there's some of that nature preserve. You can go out there and play wiffle ball, throw the football around. Really, really good for families. You'll see this is the condition of most of the interiors. This one has new LVP flooring, so excuse me, this would be something that we would do on a turn if the existing flooring wasn't in good shape. But the cabinets, the appliances, they're basic finishes, frankly. There's nothing fancy about this. But it's, standard for the market. It's clean. It's at a decent price point, and, it's in demand, most importantly. Just a couple other close-ups. There's a sand volleyball court too, which is pretty cool. I think that's a nice amenity to have. Laundry room here. There's about 10 machines and 10 dryers. We're in a contract in this property with Jets. We're going to be moving over to another company called CSC. In most of these facilities, you'll find that it's a third-party company unless you own the machines outright, which requires a lot of maintenance on the behalf of the team that owns them. A lot of these are contracted out, and what the third-party company will do is they'll actually lease the space from us, and then they'll take a portion of the income. Jets contracts are kind of prohibitive. I've been in one myself on an asset that I'll highlight later as part of our track record and our exits. And CSC has a much more favorable contract structure, and thankfully we're able to get into a contract with them. So our other income line should go up on the pro forma. Here's the financial analysis. This just kind of shows our projected returns over the 7-year hold. To start, I want to focus on kind of the top part of the screen here and the delta between gross potential rent, or in this, how it's listed here, potential market rent, the delta between that number and the green line, effective gross income. This is where a lot of operators are making headway in today's market or losing their shirts, frankly, because you probably heard this in other markets around the country. There's been a lot of supply that's come online, right? And when the supply comes online, if there's not robust demand, these apartments that are in lease up have to offer concessions. They have to offer discounts to investors. Maybe it's a month free, or it's 2 months free, or whatever it might be, free internet. So that's costly, but it pulls people into the community, and they can hopefully stabilize their rent roll over that period of time. But that costs existing apartments in the area money because they have to compete with this, and they have to in turn offer their own concessions or renew leases at reduced rates, et cetera, to compete. So it's a very competitive environment. It can drive up vacancy. And then, there can be, in a recessionary period, there can be collection loss and bad debt. If you don't have the right property management team in place, you can have a lot of downtime in their renovations when it comes to turning units. So I think we have a great situation here with this asset to avoid a lot of those pitfalls. The market doesn't have a lot of supply. Nothing's come online in a decade, as I've mentioned, and we're 99% occupied and the preferred vendor of the largest employer in town. Renovation downtime should be mitigated. I mentioned the on-site team that's there today that we intend to retain, and they're turning units very, very quickly. We don't have to offer concessions. We budgeted for it on the pro forma here a little bit, as have we with vacancy that's higher than what has been historical. But we don't anticipate having to offer concessions because there's really nothing, as far as new supply coming online, and there's still demand there's just the right amount of supply for the amount of demand that's in the market, and we're one of the nicer communities. And then collections and bad debt, that's a real problem at pretty much every asset that you run into. There's going to be a little bit of that. But we think that with the family sort of dynamic that we have, looking back at historicals, we budgeted this very, very conservatively. So our delta between what we anticipate collecting and what we actually collect should be really, really tight. And our effective gross revenue should be positively impacted in that regard. And I think we can operate the property really smoothly and basically protect that cash flow. And then from an operating expenses, just from a high level, we're budgeting roughly 50% of an OpEx ratio or NOI margin, whatever you want to call it, meaning that we're going to take about 50% of what we collect in rents and use it towards operating the property. And we're going to keep the rest to service our debt and then pay our distributions. And I think we've done a pretty good job of being conservative on what our operating expenses are. I think we have a great partnership with J&G, who's going to help us run this property really efficiently with all their core competencies and historical track record of being one of the best property managers in the state. And I think we're in a good position as far as just the bottom line being really protected. We're going to be doing a drop and swap, which is essentially an entity purchase to hopefully reduce real estate tax liability. Actually, taxes for next year are assessed lower than they are this year. So there's all good things happening here, and I'm happy to dive into this more, outside of this webinar recording. But you know how to get in touch with me, and we can talk more about it. But I think we've got a really conservative pro forma here. We've got underwriting that I think backs it up and supports it with third-party data, and we've got a solid operating team to make this come to fruition. So all in all, the plan is there to be successful. Some repetitive information here, but to highlight on this page, the debt service coverage ratio is 1.78% going, or 1.7x going in. Fannie Mae requires a 1.25 debt service coverage ratio, meaning that the property's NOI has to be at least 25% higher than the debt service. In this case, it's 78% higher than the debt service obligation. So again, that speaks to just how much cash flow is available with this asset, and having a debt service coverage ratio that high and a break-even occupancy of 73% indicates to me that this is durable cash flow, like meaning that a lot could go wrong. There could be some tough situations. We could weather a recession. We could weather a economic downturn. We're in a position to be able to ride this out and not be stressed out about, basically making this investment come to fruition. So I think it's a lower risk profile, cash flowing deal. And you'll see the yield on cost there. Untrended means that in these percentages, we're not baking in any rent growth. We're basing it on today's rents as it relates to this specific metric, which I think is more conservative, obviously, than trended yield on cost, which would say we've seen 5% rent growth over the last 2 years. We're going to put that out into the future and calculate yield on costs, including that rent growth. We didn't do that here. We left it untrended based on today's rents. And you can see, I mentioned we went in at a 7.74 going in cap rate. That's going to drop to an operating cap rate of 6.96. That's because of the CapEx that we're spending, and we're not anticipating growing rents, but it will grow over time. And at year 7, you can see at 8.56%, if we sold it you see the sensitivity table towards the bottom there. If we sold it at a 6.75 cap, you can see what our returns would be at the project level, 17.55%. That's higher than the cap rate in the market today, which is probably closer to 6.25 or 6.5. So, we've got insurance on our principal in the case where we've got a yield on cost that's above the current market cap rate. And we've got, obviously we're showing that we can increase the value of the property because that operating cap rate is going to be higher than what we think will be the exit cap at that time, if that makes sense. I just want to touch on the fees a little bit. It's a 2% acquisition fee on the purchase price, asset management fee of 1%, a loan guarantor fee of 0.75%. I think the asset management fee is a little bit lower than what you might normally see. Loan guarantor fees sometimes are there, sometimes not, but between the two, I think we're still below, typical 2% asset management fee, for example, if we combine those. Refinance fee of 1%, probably not going to come into play, but it's there. If we, ended up holding it longer than 7 years, that's where that would probably come into effect. but the business plan is to dispose of it and do a disposition at year 6, 7. Property management fee of 3.25%, and that is just the fee to the J&G property management entity. There's also payroll, that would be salary, benefits, et cetera, for on-site staff. And then there's a 7% construction management fee for approved CapEx, and that's the 485,000 that we touched on prior that'll be used for the exterior renovation. So it's kind of a nominal amount, but worth mentioning. I want to also highlight the waterfall structure. It's an 8% preferred return. And then following that 8% preferred return, it's a 80-20 split, 80 to investors and 20 to managers. And because there's such high cash flow, there will be some promote paid above the 8% during the whole period to managers, which from our standpoint is helpful in covering overhead, et cetera. Once we dispose of the asset, we will basically get all investors up to a 15 IRR at that time before we then split again 80-20. So there's not an additional hurdle, so to speak, but there's sort of a catch up to get to the 15% when we sell it, because there will be some proceeds paid above the 8% pref to managers on an ongoing basis. And then below is a picture of the financial summary. It's a Fannie Mae loan, 5.76 million. It's 76% loan to value, 66% loan to cost, and that number being lower, 66%, because we are raising the equity that we need to fund the CapEx that we highlighted before. It's a 7-year term that needs to be updated. It's not 5 years, it's 7 years. It's a 5.6% interest rate. Roughly, we're going to lock that later this week, so it'll come in give or take by 5 basis points of that number. 48 months of IO, which is attractive from a cash flow standpoint, and then it'll start to amortize. The yield maintenance is the prepayment penalty as discussed. It's a non-recourse loan. We do anticipate doing cost segregation and bonus depreciation, I think as I mentioned earlier before, with a closing date of December 23rd, and this is a 506C. Not much really to show here on this page. This is just the sources and uses. You'll see, how we're sourcing the closing and then the uses of the closing amount and the equity that we raised post acquisition. Some of it's for reserves, for CapEx, for closing costs, et cetera, et cetera. But the total amount, as far as uses at closing, is almost 8.7 million. All right, so let's talk a little bit about Richmond, Indiana, because I don't think a lot of people are that familiar with it. It's only about 20, 25 minutes from where I went to college. I went to Miami University in Ohio. So, Richmond is right across the border there. It's about an hour and 15 minutes from where I live. So it's about an hour from Indianapolis. It's an hour and a half from Cincinnati, and it's about 45 minutes from Dayton. So that's about where it sits on a map. We'll show that in just a second. But it's got some great universities, colleges in town. Earlham College is a private liberal arts college that's nationally recognized, Earlham College. Indiana University East is there. That's a satellite campus for the main campus in Bloomington. And then Purdue Polytech is there as well. It's really close to Whitewater Gorge Park and Brookville Lake as well. These are beautiful, state parks that have recreation opportunities, hiking, some surprising geological features for the flatlands of Indiana, but they're all right there. It's a really charming town. I spent some time out there when I was in my prior career and working with clients, as I think I mentioned earlier. And I always enjoyed my time out there. So Richmond's kind of a cool little town. To speak to where it sits on a map, I kind of mentioned that already, but you see where it kind of falls between Indianapolis, Dayton, and Cincinnati. And then as far as employment and economic drivers, it's got a pretty diverse economy for a small town. I mean, it's 35,000 people. It's not huge. It's not growing all that much, but it's not shrinking either. The main employer there, the biggest employer is Reed Hospital, who I mentioned is, our asset here, Ivy Green, is their preferred community as far as apartments to send people to. And we oftentimes we'll walk into a situation where we have a wait list, namely because of that relationship. So healthcare plays a big role, education, as I mentioned before, with the colleges that are in town, and then manufacturing. You can see some of the employers' names there, but it's automotive components, plastics, packaging, precision metals is another industry that's there. So, quite a robust little economy for a smaller town. But where it sits, and with Indiana's kind of manufacturing legacy, It's a lot like some of the other markets we've been in where manufacturing played such a key component probably 50, 75 years ago to the economy. But towns that have been successful in the Rust Belt from sort of moving themselves away from just manufacturing and focusing on education and healthcare in particular, these white collar jobs, have been really successful in keeping their economies and their populations stable. So that's what Richmond is all about. This is a couple of case studies to highlight sort of our track record and what we've done at InvestWise Collective. We do hold some assets in our personal portfolio. If you were with us earlier this year in Heritage Square, that was a 183 unit property that we acquired in another partnership down on the Indiana side of the Louisville MSA. We've done some assets on our own as well that we've exited just recently. One is Oxford Terrace. This is the one that Kevin Burns, who's part of the J&G team, helped me with the disposition as the broker. Pretty challenging property, really. It was 50% occupied when we acquired it. It was a heavy lift, a lot of vacancy, a tougher tenant base, a lot of deferred maintenance, all across the board. We had an opportunity to really hit it out of the park. We had a buyer who, after a year, gave us a great offer. And if you remember back in 2022, rates really started to accelerate and take off. So they had their lender pull out of the deal. Lending tightened up quite a bit, and we fell out of contract. So at that point, with the rates where they were, we felt as though it was best to hang on to the property, continue sort of phase two of the value add, which we did. And returns were hit a little bit with a longer hold period, but in the additional capex we spent and the lower price than we got from the initial buyer's contract, but we still ended up with a 15 IRR and a 1.6 equity multiple. I think this asset really taught me that having that downside protection and having more than one exit strategy or plan B was critical to a business plan. And we had to use it. And we still came out with a great outcome. But if we didn't have that plan B, it would have been challenging for us, to hold this property. I don't think we would have necessarily lost money, but it wasn't one where we got into it thinking, hey, I want this to be part of our permanent portfolio. It was sort of intended to be a quicker flip. So this was one that I'm proud of. But thankfully we had that plan B in place. And this was one where we bought at the right time and we got some market tailwinds. This is Foster's Cove in Evansville, Indiana. Bought this in 2021 at a great basis from a distressed seller. And again, 70% occupied, a lot of deferred maintenance, budgeted, considerable capex spend on the front end, drove rents beyond where we thought we could take them because we got some tailwinds from the COVID pandemic, and was able to refinance after just over a year of ownership and pull all the initial capital out of this deal. And then we were able to hold it for another 3 years and still have it cash flow really, really well. We got an offer from a buyer locally in Evansville who I'd known for a couple of years that really wanted this asset, and we found a price where it was meaningful to let it go. So we got a 51% average annual return on this one and a 3x multiple plus. So this was a really good outcome. But I wanted to share these with you. These are a little bit heavier of a lift than what we're walking into with Ivy Green. And we also didn't have that partnership with J&G on either one of these. So I think we're better positioned on a more stable asset to cash flow really, really well because it's already there. There's not some heavy value add business plan like these two assets show where we're capable of doing it. But in this particular asset with Ivy Green, we've got more of a down the fairway type of asset and a pretty smooth, I think, investment plan. So this is what the timeline looks like. Registration for this was today, November 3rd. Our funding due date for our capital call is going to be December 10th. That's when our funding deadline is. We're targeting to close this opportunity on December 23rd this year. We should be able to meet that, I think, smoothly. And then our first distribution will be paid out probably late April, early May. We're going to pay quarterly distributions on this deal. We're going to operate it. Obviously, if we take it over just before the turn into next year, into 2026, we'll have it for first quarter of 2026. We will close the books, which typically takes about 30 days to do, calculate distributions, and then send them out. So it'll be sometime around that late April, early May time period. And we intend to hold this for a 7-year period. So it should be anywhere between 5 and 7 years. And we'll see where market conditions are at or what, may come of a, potential buyer sooner than that if there's a great offer price or if things change in the market where it dictates an earlier sale to the upside. We'll certainly consider those scenarios given the yield maintenance that we have. So We should see subscription docs. You should see subscription docs on our portal here coming in the next, I'd say 7 to 10 days. It's always kind of a hang up to get those documents procured. And as soon as we have those, we will definitely share those with you, and they'll be available. But in the meantime, if you have any questions, as I mentioned, my email directly is paulshannon@investwisecollective.com. You can reach out to me. I apologize again for not having the recording from our live webinar earlier today where we had J&G on with us, a little technology snafu, but thank you for bearing with us. And hopefully this supplemental recording has been helpful in kind of understanding what we have here as far as an asset, the investment opportunity, and how we feel we have the right team in place to support a good outcome for you investors. So thanks for your time today and watching this if you've made it this far, and we look forward to hopefully talking with you soon. Thank you so much.